I don't have walk-in music for you, so although we should do that for next time. Yeah. You guys pick your own song. Thanks very much for joining. I like Chad. This last year's version of this was my favorite panel ever. I spend an improbable amount of my life sitting in board meetings. In fact, I have to, right after this is done, I have to drive to San Francisco for another board meeting. So this is how I spend my day. This is how all of the panelists spend a shocking amount of their day. The VCs, it seems like if they're not in a board meeting, they are either preparing for, debriefing for, dealing with the carnage that may have happened at the last board meeting, or expecting what carnage is coming at the next board meeting. So really excited to have the panel here. I'm actually going to let them introduce themselves because they obviously can do a better job than I can. So I'll let you start.
Hi, my name is Gary Swart. I was, until last week, I've been the CEO of oDesk for the last almost 8 years. oDesk is the world's largest online workplace. We merged with the world's second largest online workplace company called Elance. That deal was complete at the end of March.
And I'm actually going to stop for just a second because some of you have been in my panels. I know I recognize a fair number of faces. Others of you may not have been here. We do these a little bit differently. This is not just a place to put the wireless password. And in fact, if you need it, I would grab it because I'm going to erase that information pretty soon. What we do here is we take questions from the audience first. We don't give the answers, but we take the questions first. And then I use those as the questions and the way to guide the discussion and run the panel. So as they're making their introductions, if you guys can think about the questions that you want answered and how that'll drive the discussion. So, sorry, Jules.
Great, so I'm Jules Maltz. I'm a general partner at IVP. We're a late stage venture firm, been in business since 1980. Last fund is $1 billion fund that we invest strictly in later stage, fast growing companies, investors in Twitter, which we invested in early 2009, Dropbox, Snapchat, RetailMeNot, Supercell, so a lot of companies, both mostly in the US, but international as well.
And I'm Sharon Wienbar. I'm a partner at Scale Venture Partners.
No, it's on. Hi, I'm Sharon Wienbar. I'm a partner at Scale Venture Partners. We invest in scaling stage companies. We backed Box the year you guys did $4 million in revenue. So that's actually very typical for us, is that low single digits, super high growth, lead rounds, take board seat, tend to work pretty actively with our portfolio companies.
I'm Dan Levin. I'm the Chief Operating Officer at Box. I have obviously been on the Box board for about 5 years. I was on a private equity board for 3.5 years. I founded a company back in 1991, and I was on that board for 6.5 years. And I attended a bunch of Intuit board meetings when I was an executive officer at Intuit. So I've sort of seen various kinds of boards in various stages at lots of different kinds of companies. And I keep trying to get in enough trouble that they want to invite me back to these things, but I'm failing. So we're going to try harder today.
So thanks, and I'll start with questions. Who will be first? There we go.
Yeah, so what's the general structure of a board meeting, and what is the objective from the founder's perspective that they want to convey during that meeting to the board?
By the way, you do not have to read this. I'm the only person who has to read it. So how do you structure a board meeting, and, I'm sorry, what was the second?
What is the overall message that the founder should convey or wants to convey to the board? I think earlier people were saying, hey, just don't get fired. Maybe that's the overall message. But I'm pretty sure the founder has some strategic initiatives that they want to get done during the board meeting. How do they set that up? Either in advance or during.
Some of biggest frustration dealing with early stage CEO.
What should the communication frequency and severity be in between board meetings?
Severity is a loaded term.
Greg's scared.
Next question.
Yeah.
So mistake number 2, allowing directors to arrive unprepared. How do we get directors to arrive prepared and do their homework and not fire us?
Well, this must be, maybe everybody knows the answer, but actually, how do you choose your board members? And how do you make sure as a founder you stay influential?
Hit your numbers.
What's the right mix between detail and summary for
do boards at the private, within private companies put in KPIs or some mechanism to keep themselves accountable?
So when you do have to fire the CEO, what strategies do you use to make a transition without blowing up the company?
We actually do an entire session on that.
Appropriate board interaction with the management team versus the CEO.
Strategies for keeping the meeting short.
Yeah, hit your numbers.
Keep everybody happy. There's one cure for every ill. Take your numbers.
Make the numbers small.
No, sandbag is not.
Two more. Two great questions.
Strategies to replace a board member.
How to ensure transparent, the right level of transparency that's critical to both companies and the board.
One attribute of your favorite board meeting that you wish all of the other ones would adopt.
It's a great list. Not only because those were some of the ones that I wanted to ask, but, and yet I'm still going to start with a different one. And Chad stole my thunder because I wanted to get a reprise of Dan's answer. But I will start with you though. What is the role of the board?
Well, let's take as a given that for the rest of this conversation, unless somebody says explicitly otherwise, we're talking about a board primarily composed of investors supervising a venture-backed company in Silicon Valley, because otherwise we could go off in a lot of different directions. And I would argue that and really you should ask these guys, but a board has essentially two jobs. One is supervisory. They've invested money in your company on behalf of their limited partners, and they have an obligation to those limited partners and to their general partners to oversee your use of those funds in an appropriate way. So there's a governance and supervisory component. And then there's this, what I said last time, which is essentially a management component. I mean, at the end of the day, everybody works for the board of directors. And the interesting question is, how does a board sort of provide that kind of management, whether it's goal setting through a strategy process, whether it's goal setting through a financial process, or whether it's more directly influencing the leadership, which generally would be done through influencing the choice of the CEO. That's the other piece of what they're trying to do, I would say.
Yeah, I mean, I agree. There are lots of things that board members do that are ancillary parts of the job, helping with business development, helping with recruiting, all of those kind of things. I mean, we're there to really try to overall enhance the return of everybody in the company. Because as a board member, we do have a fiduciary responsibility to all the shareholders, not just to the investors, and in particular, not just to our series of preferred stock that we invested in. So as a board member, you're there on behalf of the entire company, but your role as a board member on behalf of the entire company is to see that the company is appropriately capitalized and it has a right management team in place.
Yeah, I mean, I think the one comment I'd just add to what Dan said too is just, I think people do get confused though whether, who's actually managing the company. Because at the end of the day, when we're investing in a company, we want the CEO running the business and managing the company. If the board is the one managing the company, you have the wrong CEO. So that's critical. And so I think when I'm sitting in board meetings, I'm not expecting to make decisions on whether we should launch this marketing campaign, display advertising, or should we buy a bunch of paid search. I want the CEO to tell me what he or she wants to do. I'm happy to give advice from other companies, but when a CEO is running the meeting, it needs to be that person actually setting the agenda, keeping things on time, telling the board what they're doing. They shouldn't be a session of brainstorming and advice, and I think that's where a lot of people get the board meeting wrong. They forget that they're in charge, and actually by ceding control to the board to make decisions, you end up weakening your own position as CEO, resulting in you getting replaced.
Right,
So,
I have a funny story, because this is actually the worst board meeting I ever attended. Was a company, late-stage company, was doing well, but then was faced with some sort of sticky issues, and the management team laid out all the sort of different alternatives, and then literally the CEO sort of turned to the investor board members and said, so what do you guys want to do? And I just remember thinking, I want an effing CEO who knows what to do. Like, don't ask me. It's not my, if you're asking me to make this decision, then I'm going to make a decision, which is to replace you, which actually we ended up doing, and the new person made a phenomenal difference in the company. But so what do you guys want to do was just he might as well have just cut his head off in the meeting.
Yeah, I would just amplify, it's hire and fire the CEO. And somebody told me once, he said the best CEOs running companies, he was a board member at I think 8 different companies, and he said, I love it when I ask a really tough question and they say, oh yeah, we've thought about that and here's what we came up with. So, they're just a half a step ahead of the board's they're not really arming and aiming, but they're asking strategic questions, and the team knows the answers.
So Jules and Sharon, I had a conversation with a client, or a very early stage client, and they were talking to prospective investors, and they asked me the question, okay, so I want an investor, if they're going to be on the board, I want an investor who's not going to get in my way. How do you reconcile that, and how much of this, what you describe and how the CEO should act and how they respond to the board, how much of this is the fault of the CEO? How much of this is the fault of the VC or VCs? I'll come to the CEOs next.
Yeah, so I don't want to get in the CEO's way. So I actually like it if the CEO came to me and said, I want you to be on the board, but I don't want you to get in the way. This is where I'm going with the business. If you want to invest, this is my strategy. I love that. So it doesn't bother me at all. I think what needs to happen is the CEO needs to make sure to be transparent to the board, to tell the board what's going on in the business, but always to have a strategy. So I think that confidence in where you're going as a business is a really good thing.
Yeah, I mean, so a VC aphorism is value add is to make up for bad due diligence. So in general, you know, we love it when the team is masterful and can take the company forward without us having to do a lot. But I think transparency is really the key issue that Jules brought up. So, for example, I have another portfolio company, very high performance team, super competitive CEO, company is doing well. However, the part where it's always sort of a gear grind when the CEO will put in 1 or 2 slides and ask for, you know, a board vote to approve, you know, some major action. And there are times when I'll say, hey, wait a second, I actually want to see the work that supports the assertions that you're putting forward. So, you know, you can't just give me the summary financials. Let's see what, you know, for example, for the annual plan for the year. You know, what did you assume about sales rep productivity and sales rep hiring that supports these financials? So what do I have, you know, in the words of my partner Rory who's on the box board, what do I have to believe? You know, I want to approve your plan, but I want to know what I'm believing in order to approve this plan. So providing that level of transparency in the KPIs gives me the trust that yes, this plan is achievable, it's appropriately aggressive, appropriately achievable. So in that case, I don't think I was in the way, even though I did stop the meeting and say, no, I want more detail before I will approve this plan. But in the end, he got what he wanted.
And I think in the meeting, if you have to be explaining the background, you know, you've already failed as a CEO, because where a lot of that should have happened is a few days before the meeting, right? That's where we're going to make this big approval. You know, Sharon, here's my thinking around it. So the pre-work before the board meeting is actually more important than what goes on in the actual board meeting.
Right, I think this can't be understated because, I don't know, I'm an ex-Bain and Company consultant and they just beat into you, you know, from age 22, pre-wire, never ask for a decision that you don't know exactly, you know, what's going to happen, you orchestrate the meeting. And that entails lots of pre-planning and pre-meetings so that by the time you get to the big decision, you know where everybody stands and it's easy to gain consensus and go forward. So I'm just a huge believer in that a half an hour spent, you know, or even in larger companies, often it's the CFO who spends time with the investors going through, you know, the details and the numbers before you get to the board meeting, which by the way is one of these big questions about how do you get investors to come prepared for the board meeting is make it your job to prepare them to come to have the strategic level discussions, and then instead of saying, you know, why is the lead gen off by, you know, X% this month?
I'm struck by what I'm hearing on a couple of dimensions. One, which I don't think is terribly controversial, is would you agree that what you've both just said is more true for later stage companies with larger boards and less true for 2 founders and 1 investor?
Oh, yeah.
Yeah, because
a lot of these guys are going to deal with very small boards, very early stage, maybe there are 1 or 2 outside board members, and I don't think the kind of like prep work and the board meeting is not for conversation or discussion is as appropriate in those smaller contexts.
I think every board meeting is actually for conversation and discussion, but it should be for conversation and discussion about board level issues, not operational level issues. And I think that's true whether it's a very small company or a large company. I mean, you know, so, but yes, the level of prep work and the, you know, the infrastructure, the admin staff to, you know, support a board and governance, you know, when scales with the business. When you have a board that's got 3 or 4 or 5 venture people on it, by that time you should either you've taken a lot of money and you haven't made very much progress, or you have a CFO and a finance staff and you're having audit committee meetings and all that kind of stuff. And so there's just a mass of action that kind of flows along.
The other thing I would say, and I don't mean to be overly controversial here, is that it might be true that for many venture investor board members, they would like it if the CEO was very firm and there wasn't a lot of, well, what did you say, value add as a replacement for bad due diligence. But in my personal experience, it's important to give your board members an opportunity to appear to add value on a regular basis.
Play us, please just play us.
I don't mean it that way. You know, like, if you go through life steamrolling your board members and never giving them an opportunity to speak up, and every time they open their mouth to make a suggestion based on what they've seen in another company saying, because you want to be firm and like you're in control, saying, oh, I don't need to hear that, we've already got a plan, that's not going to go over all that well either, in my experience.
Yeah, well, my favorite slide in board deck is the one which a few of my CEOs do this. It's what I want from you. So the CEO puts that in the board deck. Here's where you can help me. Recruiting, this strategic partnership. You know anyone at Pepsi? You know, whatever it is, whatever the issue is, I come out of that board meeting with a list of 3 things now that I need to do. Now, what's the CEO doing? He's or she they're managing me. So I'm working for the CEO in that respect, but it makes me feel good as an investor. And, you know, the CEO feels like he or she is getting something of value out of the board at the end of the day and not just getting peppered with questions. That's the worst board meeting. If it's just a combative list of questions that the board's asking the CEO, it's, you know, I love it when I come out of it saying, I know what I can do to help this company.
Right, so I think Dan's also making another point. In addition to the co-opting your board members, getting them to do work on behalf of the company, is making sure that the entire board understands understands and is bought into what risks what the company's plans are, what risks they're planning to take on, and that those risks may turn out to be positive or negative, but you did them for a reason. So you don't end up, 6 months later going, why are we here? This didn't work. Either we took a calculated risk to ramp up sales when we weren't quite sure, or ramp up expenses when faced with a financing that isn't yet sewn up. Those kind of risks. I mean, they're very serious risks, but those are board level decisions that need to be made, and so to the extent that everyone transparently and openly can say together, yes, we are going to take this calculated risk together, leaves the management team in a much stronger position. If that the right cards don't turn over, you say, but we agreed to do this, so now we're going to come up with plan B, and maybe you should have come up with plan B if you knew that there was a good chance plan A wasn't going to work, but that you haven't driven the thing off a cliff with the board members saying, well, how did we get here? This is bad. Now we have to throw this team out and start over again. So it's really that process of deciding, and that's what governance is, deciding what risks the organization should take together.
As one of my bosses once said, if you don't include me in the takeoff, don't include me in the crash either.
Nice.
Gary?
I forgot the question.
Actually, I've forgotten that question. The conversation took me. So actually, then I'll move on to the next question, which is, so how do you keep these things from happening? What do you do to prepare the team, prepare the board, prepare the room? How do you get set for a board meeting?
I have to think about what stage. I think Dan brought this up. It depends on where you are in your life cycle. And if you think about it, in the jungle, you're going to act very differently than you are in the dirt road and then on the highway. You need different tools. You need different people in the room. You're going to prepare very differently when you're hacking vines as opposed to driving the Escalade at 75 or whatever the speed limit is. So, in the early days, I put everything out there. I was over communicative. I wanted to get in the room and just broadcast how great everything was going and just talk about the business. And as we evolved, I found myself doing less and less of that. And guess what? The board wanted less and less of that very quickly. And so I think it depends on what stage you are, but I think there's 3 things that you do to prepare. Number 1 is, I think what you want to communicate are 3 major things. You want to communicate progress, you want to communicate priorities, and you want to raise problems. And you want to do this in a way so there's never any surprises. So what worked really well for me was a month in review message where I would put a high-level executive summary, and then I would say, if you want more details, the details are below, feel free to read on, but this is the high-level summary, and then I would detail each of those 3 areas. So in the board meeting, you weren't walking in and saying, okay, now let's talk about our progress and our priorities and our problems. They already had that stuff. You could focus the board meeting on what key decisions need to be made. Where do you need some arming and aiming, right? What help do you need, and those kinds of things.
Jules, you mentioned your favorite slide. What do you like to see in a deck?
I actually like, I mean, this goes back to the question about length. One of the reasons board meetings take so long is that, the CEO prepares a 100-slide deck. That's going to be a 4-hour board meeting. So whether because VCs like asking questions. We like digging on a bunch of slides. So I think the first thing is think about shortness of deck. I mean, both for a board meeting, but when you're pitching a venture capitalist, anytime you're dealing with a venture capitalist, short decks. It'll make the conversations go faster, but that doesn't mean lack of quality or lack of depth in the discussion. So having one slide at the front saying these are the top 3 things I'm focused on as a CEO is a great slide if they're really the top priorities. That gives me a lot of information. Having one financial dashboard that shows your Q1 revenue and metrics against plan and the difference is a great slide that tells me how you're doing on a financial basis. So I think keeping things to a minimum, I think is good. I think as you get later in stage of company, that I think people may be curious about who should be in the room. Obviously, the board members are in the room, but what people from management are in the room. I don't like it when all VPs are in the room, and all of a sudden you've got 20 people. That also leads to those 4-hour board meetings. But I do like it that every board meeting, maybe there's a different person from the VP team that the CEO brings in. So we have an important marketing discussion that we're going to have. Let's bring in the VP marketing and give that person exposure to the board. Is great, but that person doesn't need to sit in every meeting. You don't need to have a lot of people in the room. So that really helps keeping things concise. Just higher quality slides, but less of them.
Gary, I mean, Jules brought up the question or the comment about team. Sorry, Dan.
Can I get in one
yeah,
more
absolutely.
before you change topics?
Yeah.
I actually feel pretty strongly, and I understand that there are other people who see the world differently, that a very small percentage of the materials that you presented at your board meeting should be created for your board meeting. Basically, if you're running the business well, and I don't care what stage you're in, the only things you should have to prepare for the board meeting are the first slide, the CEO overview, which you may not need to prepare for any other reason, and the back of the deck, which is the administrative items, the granting of stock options and stuff like that. You should, and this goes to getting your board members to prepare, you should have KPIs that you use to measure your business, and you should tell your board members, these are the KPIs we use to measure our business. If you would like to give us some suggestions about other KPIs that we could use, we'd love to hear that. But we're not producing KPIs specifically for the board, right? We have a business to run. We're going to produce materials to help us run the business. Similarly, the update on what's going on in one of your key functions or the framing of some important decision that needs to be made should be very uncommon that you need to bring that stuff to the board. And by way of preparation, board members are just human beings, and I understand that we all view them as being these ethereal entities because venture capital is somehow, this mythical thing, but they're just people. If you treat them like people with appropriate respect, you will get the results you want. So if you go to your board at your first board meeting and you say, here's the deal, I'm going to send the board deck out a week ahead of time. There's going to be a lot of material in this board deck, which we are not going to review in any detail in the meeting itself. I expect you to have read it before the meeting and to have prepared any questions that you might have. And then in the meeting, you don't go through every slide. You hit the high points and you treat them with respect, like if they want to ask you a question, they will stop you and ask you a question or dig in on something. You will find that none of them want to look like idiots. They're just like you and me. They don't want to look unprepared in front of their peers, in front of their colleagues, and they will do the work ahead of time. If you send them out the deck 2 days before, and then in the board meeting you go through every page of the deck slide by slide, you're basically training them not to bother to prepare, and you're going to get what you ask for.
I mean, just to echo something you said, so that, I really do believe use the same thing, using management's dashboards. And please, actually, like snip out the Excel and paste it into the PowerPoint. One of the things I hate in board meetings is word slides with numbers, especially word slides with numbers that are for a point in time with no context. So I really like to see trended data. Ideally multiple quarter, this quarter, actual versus plan, outlook for the rest of the year. And then you can also use that, just make a red oval in PowerPoint where there's a variance. What's really handy for your board members is to say, we're going along, things are going swimmingly. Here's someplace where we need to pay attention. Here's where we had an actual versus plan that was very different, or a trend line that's very different, and this is what we need to talk about. So you can, you just use those little handy PowerPoint tools on top of a plain old Excel spreadsheet. I really don't want you guys to invest in fancy graphics presentation of numbers. Numbers should just come from a spreadsheet, because then also they foot and tick and tie and all that kind of stuff. Well, which when you type them over again in PowerPoint, they don't, and it just introduces error and it takes time, so it's a bad decision all around.
Dan, when should a CEO send out the board back? If not 2 days in advance, when should they be getting it?
I mean, if I'm a board member, I want to see the deck 4 or 5 days before the meeting at least. Give me a chance, because I'm a busy person with a busy schedule, give me a chance to find some time to look at it. Don't send it to me 2 days before. And if it's convenient, I like to have it over a weekend before the board meeting, because weekends are a good time for me to review stuff.
Gary, not that you ever had to do this, how do you communicate bad news? If you know that one of the slides in the deck is going to have a red circle around a variance, that, man, we really blew the quarter for whatever reason.
Infrequently. No, I mean, the key here is no surprises. Good news or bad news, just keep make it news. And I think if you get on that monthly cadence where you're just always telling, you're always communicating, you're transparent, that's a good way to do it. Back to this whole, if you're running the business the right way, there is very little board prep. That's the way we ran our business. And then it becomes very templatized, and then your board members get used to it. And it just becomes a much easier way of communicating, right? It's not that the board meeting is the event to communicate it. It's that communication is always there. Your dashboard is, your KPIs are your KPIs. So if you do have some disappointing news to communicate, I think you want to do it swiftly, you want to do it clearly, obviously, unemotionally. The more that you ride what I call the roller coaster, you're riding the highs, you're riding the lows, your team is going to follow you there, and your board may as well. So it's better to try and stay as even-keeled as possible, and just very directly and openly you want to communicate all bad news. And you want to do it early, so as soon as you know and you have enough idea of, hey, there's fire, or there's smoke, and now we know where the fire is coming from. You might want to communicate, hey, there's smoke, but you might also want to take a day and see where the fire is first, early and often.
I think it's a really good point. I had an interesting story recently where one of the CEOs called me, or actually sent an email to the entire board because the servers were down, which is a pretty big deal. And the servers had been down for 15 minutes, and he immediately emailed the board, and then an hour later they're back up. So, but it felt like, all of a sudden, I'm riding that roller coaster with the CEO. I loved that person was communicative, but we don't need to know everything all the time. If you have a bad day or you think somebody might leave, we don't need to know every piece of bad news. You do have some time. What shouldn't be a surprise is anything that's major in the business in terms of financial performance or a major employee leaving. So if you miss the quarter and it's, you missed Q1 and a board meeting's coming up next week, you need to tell your board right now, because the board should not be surprised by financial performance. If you are thinking about firing the CFO of the company, you should tell the board. So that shouldn't be, and usually the best thing to do is say, I'm going to do this. I just want to let you know. So I think the big decisions are great, but if the servers are down, or someone, you're worried about this one customer and this one geography, and you don't need to tell them everything.
Right. financial flash reports at the end of a reporting period, depending on what kind of company you have and how tight you are on cash. It could be weekly, monthly, quarterly. But we all know when the end of period ends and we sit there at our desk wondering, like, how is company X doing? So you should answer that question for us by proactively sending us a note with, the quarter was back end loaded and some of those deals didn't come in, or it's a run rate business, e-commerce or web service business where every week you've got the team is having a weekly KPI meeting. You can send a weekly report if you're in a period where the numbers are changing a lot week to week. When things are settled down, you can go to monthly or quarterly.
Yeah, and make it brief and to the point and quick. Maybe this is the time where I should make my confidence comment, because it has to be said at some point, and you can all watch the video. I'm sure I did a much better job last time. But engineers tend to be very content focused. We tend to think about very black and white things, about numbers, about code, about uptime. And a lot of us are not as thoughtful as we could be about the interpersonals. And one of the things that's really important to understand, and this is true of your boss, but it's really true of your board, is every contact with your board is either accretive or dilutive to their confidence in you as a leader and as a leadership team. And really the only tool at their disposal, the only concrete action that a board can take is to fire the CEO and put in a new CEO. And they can influence in a lot of ways, but that's sort of the big hammer that's at their disposal. And so just as I, as a CEO, or in my case COO, but the whole company reports to me, I'm in a constant do loop of, do I have confidence in this leader? Do I have confidence in that leader? Do I have confidence in that leader? And that's all I do. Like, I only have 2 do loops that I run, and that's one of them. I'm constantly evaluating my team. Your board is constantly evaluating you and whether you are the right CEO to be running this company. And every time you touch them, every time you say something to them, every time you have a board meeting, it is either accretive or dilutive to their confidence in you as the leader. And you should be really thoughtful about that. And they don't expect you to be perfect. It's okay to make a mistake. It's okay for bad things to happen. Nobody expects it to be upped and to the right with no flaws all the time. But the way you deal with the bad news is hugely impactful to their perception of you and their confidence in you. If you're upfront about it, if you're clear in explaining what went on, so there's no sense you're trying to hide something, if best case you have a proposal for what you're going to do to fix it before you have to tell them that the bad thing has happened, like, my CFO has decided to resign, and here's the slate of candidates that I'm interviewing next week to replace him. Aren't these people impressive? I think they'll be a step up, is a huge difference from, oh shit, my CFO quit. So, it really matters. The content matters. The fact that the CFO is leaving really matters. But the way you communicate it, and whether you have a solution ready or a hypothesis for what happened and a set of experiments to run to fix it already in mind, has a huge impact on your board's perception of you as a leader when you're communicating that bad news, and a huge influence, therefore, on their confidence in you and in the likelihood that they will eventually feel the need to make some change.
And by the way, all of that is true in the financing process itself, too. So before you get to having a board of directors, every interaction with the investors is evaluative. And, but a lot of times what we're looking for is not just the content of what is the answer. I'm really looking for what was your thought process that led you to that answer? Because that's what I'm really looking for, is how do you think about the world? How do you approach problems? How do you approach opportunities? And is that a good, in my mind, a good process, and demonstrably, repeatedly good process, so that when we wire you money and we're working together, you're going to keep using those good processes to keep making good decisions.
That's one more quick anecdote. So I run an orientation with every group of new employees that we hire, and I go through our corporate values. And there are freaking people doing email on their phone while I'm explaining to them our values. And they're inevitably 23, and what's going through my head is, you do not understand that if you are in the room with me, I'm evaluating you. I know your name, I know who you are, I know who you work for, and I'm taking notes. And your board is doing the same thing. Every time you touch them, they're evaluating you. And that's what they should do. That's literally their job, the definition of their job, just like it's literally the definition of my job. We all need to understand that.
we have a term for that in law firms. We call it lack of lack of judgment. If the CEO is talking to you, then you shouldn't be on your iPhone. That exhibits a lack of judgment, and that corresponds to a bunch of other things that they do. Jules, kind of continuing on the operational theme, and we'll get back to more big picture issues, but the lawyers will tell the board and management that certain things must be approved. If you're amending your certificate of incorporation, the board has to approve it. If you're entering into a real estate lease, the board has to approve it. Beyond the things that the lawyers tell you need to be approved, what do you expect the CEO to come to you with and ask, not just for your input and your thoughts and whether you think it's a great idea or a bad idea, but formally, what do you need to approve? What do you want to approve?
I think key hires. So I think on the recruiting side, if you're hiring a CFO or you're hiring someone who's incredibly senior in the business, a new president of the organization, a COO, you want input into that, or at least understanding of the CEO's thought process in that particular decision, because that's going to be tremendously important to the business. Anything around an acquisition, especially anything that requires capital, really, because companies don't fail because the product sucks. They fail because they run out of cash, right? So anything that is going to take cash away from the company in a major way, you're going to do a $5 million Super Bowl commercial. I hope that is a decision that the board has input on, or at least the reasoning of the board is there's some discussion around that. But I don't need, I don't want, again, I want to be very careful about the venture capitalist role. We're not running the company, and we're not qualified to. Some of us are previous operators, but that was often a long time ago in a different industry, and things change. And so I actually think that it's important that you don't ask too many things for approval, but you do notify the board what you're doing when it's affecting cash and when it's affecting the composition of the team and hiring.
I would say you should look at decisions and say, is it reversible or irreversible? And if it's reversible, you may want to tell the board. If it's irreversible, you definitely want to tell the board. So anything that's irreversible. One in particular for us had to do with price. So we were going to modify our price in a very significant way, and we had a 75-page deck that we had prepared, and for whatever reason, this was years ago, I thought, well, maybe the board would want to see that deck, and we got about 5 slides into that deck, and one of our very strategic board members said, is there more risk in underpricing or overpricing at this point in our life? More risk in overpricing or underpricing? And we immediately shut off the projector. The deck was over. The answer was overprice, and the board had enough confidence in our ability to come up with the right price. So it wasn't we weren't really looking for guidance or sign off. We just wanted to communicate what we had done. And to Sharon's point earlier, we had all of the numbers. We had all of the data. We had what should you believe to believe. But they saw enough confidence 5 slides in, and they were like, we don't need to go through all of this. So if it's irreversible, I think you definitely want to communicate.
I mean, I would say, again, in many ways, I view my interactions with my board the same way I used to view my interactions with my boss. And I would say this is a perfect example. By the time you're 20 people, you should have business rules in place as the CEO with your team about what they can do and what they can't do without your approval. And those business rules should be written down. And I would do the same thing. I do the same thing with my board. Just let's have a conversation and let's write down a set of business rules. This is a definition of materiality. These are the kinds of things you want to approve. These are the kinds of things you want to have a voice in, but you don't necessarily need to approve. And yeah, of course, not everything is going to be covered by the business rules. Judgment is required, but we have a context within which we can operate, and then you don't have to guess what the answer to this question is.
Right, and again, the role of the board is the 2 big things. Management is in place, and the company is appropriately capitalized. So one of the way I think about it, I'm an ex-product person, but I talk like a finance person sometimes, is asset allocation, and the board should be aware of and approve major shifts in asset allocation, meaning temporal asset allocation, increasing the burn rate, right? So increasing the net amount of money that goes out of the company every month, it shortens your runway. That should be a board level decision, right? So, and it may be that it happens on an annual planning basis and the burn ramps up on plan. So then as it happens, you don't need to keep revisiting that unless something else isn't going the way. But other changes, so for example, shifting from we're an engineering-driven organization to we're going to really ramp up sales now, and we're going to see how that goes. Like watch the Mark Leslie talks on sales learning curve, you know, and all the stuff that comes on lean startup, and you know how you monitor that those early investments in sales. It's a big shift in going from, you know, we're 10 engineers to we're 10 engineers and 10 salespeople flying around the country with suits and watches and stuff like that. And that's a shift in how you're spending your money. That should be something that the board is looking at.
It's kind of shifting gears.
Checking my watch.
Nice. Yeah, or
Should-
yeah, fancy phones.
Shifting gears a little bit, Dan, you mentioned the ethereal nature of directors. And how do you choose a board member? And obviously, if you've got a VC coming in, they're gonna appoint a board member. But as you're bringing on new investors, you know that there's a good chance they're going to be on the board. How do you look at them to figure out, are they going to be an angel on high or from down below?
Well, first of all, you should be so lucky as to have the choice. I mean, realistically, some companies have a lot of choice and some companies don't. If you have a lot of choice, then I think there's just a couple things to keep in mind. One, sometimes what you're after for momentum or visibility reasons generally is the name of the firm, and you don't care all that much about, I mean, the partner will obviously matter, but you know, you really want whoever to be an investor in your company, and you're going to take who you get at whatever valuation you get. I don't like that strategy, but I know there are plenty of people who do it. To me, the person who's going to be on my board is the thing that matters more than anything else. And I want to get to know them as a human being. I want to talk to other people that they've worked with. I want to understand how deeply they grok my business and my business model. And I mean, it's sort of funny because of the conversation we had earlier, but a good board member adds a ton of value. I mean, when I think about John Hummer, who was on my board in 1992, he was invaluable in especially the financing strategy of our business at the time. So to me, it's who's the person? What have they done? What other businesses like mine are they invested in? Can they demonstrate a clear understanding of my business model? Do they know the players, either that I'm trying to sell to or that I'm trying to hire or that I'm trying to partner with, and can they make introductions? Are their values and ethics aligned with mine and with those of my company? And you know, if you are fortunate enough to have choice, you should be interviewing them as much as they're interviewing you, and you should be, and you can be, quite directive about the human being you want to be involved, not just the firm that you want to be involved. And if the firm isn't prepared to make that commitment, then you can choose to do business elsewhere.
Gary, what do you look?
If you think of this in 4 buckets. There's personal characteristics, there's motivation, there's skill, and there's knowledge. So what are the personal characteristics of this person that you're going to invite onto your board? What's their motivation? Why do they want to do it? What's in it for them? Getting a really good understanding of that. What skills do they have? And then what knowledge do they have? And by knowledge, I guess I really mean domain expertise, similar company, similar experience. You're a security company and they've worked at, or they've got a security background or worked on a board of another security company. And of those 4 things, I think the far and away the most important thing is the personal characteristics. Those are the things that you can't change about somebody. And what I think happens is most of the time we make hiring decisions, not only for board members, but also for employees, based on the skill and the knowledge, and not enough on the personal characteristics and the motivation. And what you may find out is that, yes, they have deep security knowledge, but that's fleeting. That's the first thing that goes. That's the first thing that a smart person can pick up. So you should only focus on the personal characteristics and motivation to get to know somebody. Once you know those things, or the skills and the knowledge may be table stakes, but it's all about the characteristics. And before you know what to interview for, you have to have a good handle on what it is that you want and what's your motivation and what are the personal characteristics or values that you need from a board member. And don't even meet people until you know what that list looks like.
So, Jules, and I'm absolutely making up this statistic, but the average tenure of a Series A investor on the board of a successful company is longer than the average length of a marriage in California.
That's true. That's probably, yeah, I think 8 years for a board member, probably 5 to 8 years.
Yeah.
It's easier to get divorced. No, I don't know from experience.
So that's the question. If you have irreconcilable differences between management and the investor director, what do you do?
I mean, the tough answer is you're stuck. I mean, pretty much you're stuck as the CEO. So, you know, you can do certain things, there's options. So if you really have a disruptive board member, I'm talking about an investor board member. If it's an independent, you might have a little more freedom. But if you have a disruptive investor board member, your options are you could go around that person to someone else at that person's firm and tattle on them and say that they're terrible and I want someone else. That's a big risk because it's pretty likely the board member will find out that you did that. So you've now destroyed whatever thread of a relationship you had. So
if
that
you're going
is,
to shoot the king, you better kill the king.
but that is an option, right? It puts your own position at some serious risk. I think the best thing you can do, honestly, is just try to neutralize that person. And it's sad, but it's making sure they're the least disruptive as possible to the business. So less frequent board meetings is one way to do it. Making sure you add additional people that can be your advocate to the board. And I always love it when CEOs have a mentor CEO on the board with that person. So somebody who almost they aspire to be. I'm on the board of Retail Me Not, and Connor Cunningham is the CEO of that company based in Austin. He's got Brian Sharples, who's the CEO of HomeAway, on the board. HomeAway is a $4 billion market cap company, or $3.5 billion. Retail Me Not's a $2 billion company. But as Retail Me Not was going through the IPO process, having Brian as a mentor CEO is really important. But to the question of what you can really do, I mean, you're stuck, which is why it's so important that you evaluate us when you're making the decision whether to choose us as an investor and as a board member. If we don't respond for a few days when you're in diligence with us, or we don't read the materials you prepare and ask bad questions, you've got a pretty good idea we're going to do the same thing in the board meeting. So don't be surprised. Make sure you evaluate us.
But this is also a place where you really can and should lean on the other directors and the other investors. So if your disruptive board member is the lead investor and owns 45 or 50% of the preferred stock, then you're pretty stuck. And the thing to do is recruit a really strong outside director onto the board, someone who it's not so important that the CEO looks up to that person. It's somebody who has such stature that the investor board member will also listen to that new outside director. But if you have a syndicate of a bunch of different investors, who each have a 15 or 20% stake, and one of those people becomes disruptive, that's a really good time to use the other investors to lead by example, to have a one-on-one, call with that director and say, hey, you were disruptive in this meeting. It's demoralizing the team, or it derailed the conversation. And even to use them to stop bad behaviors in a meeting. But you have to orchestrate that with a bunch of phone calls offline, gain consensus with individuals, and then get those people to come out and be your advocate and defender versus the other board members.
Yeah, unless the person is a principal or a very, a non-equity partner in the firm, never take them on. If you can't live with them, the only real tool at your disposal is to find another investor to take that investor out, which is hard and complicated.
Gary, what do you do to manage? No, sorry, Sharon.
Oh, well, another tool you can use is to form committees and to take some, but this is generally for larger boards, right? I mean, if you're a small board and your first investor is a jerk, then you're kind of stuck. But as the company has scaled, and again, if you have a syndicate, you have several board members at your disposal, you can take more of the work to happen offline, out of the board meetings, in committee, so audit committee or a recruiting, you know, many of the companies have a recruiting committee. When you've got, you know, you're hiring a COO, you don't want to have 7 people have to meet those candidates before you make a final decision, because then schedules will mean you never get to actually talk to the good candidates. So you can take critical decisions that have to be made, delegate them to, you know, 2 or 3 people on the board, and just not assign that that cretinous person onto the key committees, and that helps keep things moving along.
One other thing I would say is, smart people very rarely do nasty things intentionally. Sometimes they do. But, you know, I would just be really upfront with the person in private. I would just take them aside. Now, you know, I'm old and decrepit and, you know, younger people may have a harder time with this. I would just take the person aside and say, hey, in the board meeting, I saw you do this. It made me and the other people in the room feel like this. Can you help me understand why you did it and what you had hoped the outcome was going to be, so that, you know, we can all learn something together, and just tackle it head on. And you'll actually be surprised how often that works with employees, with board members, whoever.
Right, the send deny message when your kids are done in school. The other thing, actually, just as an aside, in Silicon Valley, with investors who are part of the Silicon Valley ecosystem, and I'll say Silicon Valley broadly defined as, you know, East Coast, West Coast firms, we all work in syndicates, and we all have, so we don't want to piss off other investors from other firms who might show us a good deal later. We want to invest in one of their companies, those kind of things. So that tends to be pretty nicey. Where you get people who don't play by those rules is when they're not in our game. We're in a multi-period game, multi-period, infinitely long game. When it's a person who's, you know, got one investment in a startup and has a bunch of other metal bending businesses in the Midwest or something like that, and they're accidentally here, they don't, number one, they don't know the rules. Number two, they don't really care what the rules are, because they don't need you. They don't need the other investors around the table. And so they can be jerks with impunity because they're, you know, because tit for tat doesn't work for them. So think carefully. If your only source of capital, this is actually a big issue, I think, for young startups who sometimes get backed into their only source of capital is some non-traditional investor, not part of the general ecosystem that invests in your sector. It can sometimes become very difficult to get the next financing, because that original investor, you know, wants to defend his or her ownership, so, you know, took some terms in that initial round that are non-standard and you can't replicate in later rounds, and it ends up being a toxic single round financing. And again, it's because those people don't have to do business with us. You know, we do a lot of business together, so we have to be respectful to each other. Those people who don't do a lot of business with us don't have to be respectful to us. They don't have to be respectful to you. And so sometimes it's better to take less capital, lower valuation, and have a deal that is financeable for the next round, rather than take some high-priced, termy money from a person who doesn't have the relationships.
Gary, what's the right time and how do you choose an independent board member?
Just one final thought on that last question. I had a situation where we had a very strategic board member, we had a very tactical board member, and we had one right in the middle. And the very tactical board member consumed a ton of energy. Why is the website blue? What are you doing about Japan? Have you thought about this feature? Hey, I tried to do this on the mobile and it doesn't work. Very, very tactical, to the point where every time the phone rang, it got to the point where I wouldn't answer the phone anymore. And that's not a good situation to be in, and that same behavior was exhibited in the boardroom. And the only way to address it is to hit it head on, which is to talk to him directly and say, this is time consuming, it consumes energy, it doesn't really work for me. So we need to find a better way of doing this, but you know, I already told you what the priorities are, and nowhere on there does it say double byte encryption and we're going to Japan. So it's not on the roadmap for 3 years, so don't ask me when's this feature coming out. So you have to be direct, you have to hit it head on, and to the extent it continues, you have to leverage the other board members. Question about when is it time to bring on a board member? Well, I think you're always recruiting. You're always thinking about getting help. As a CEO, I was always asking for advice from other CEOs and from people, and I guess I was always thinking about who would be a great independent board member, but you do want to do as much trying before you buying as you can, right? Try before you buy, get to know somebody, get to know those personal characteristics and motivation. Once you get value from someone, then you can invite them on the board. I think that's the best way to do it, is to get value in advance.
More tactically, when you, and it was mentioned the role of committees, boards will usually also go into an executive session where it's just the board and the CEO and certain, some or all of everybody else in the room leaves. Sharon, what's the role for an executive session? What do you hope to accomplish usually in that?
Yeah, that's great. So, and there's kind of two layers of it. One is part of the board meeting where it's the CEO is the only member of management who's in the board meeting, and that's a time for the CEO to let down your guard a little bit and say what your real concerns are. Because, as a CEO, you have to suck it up all the time. Like, you're straighten up and fly right, I have confidence. Because you're signaling confidence to your team just as you're signaling confidence to the board. So when the team walks out and the door closes, you can say, I'm really worried about my CFO, or I'm not sure we're going to make this quarter's numbers. I know that guy just said, we've got 2.9 times coverage in the pipeline, blah, 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 but, I'm just not seeing the conversions happen, and, I'm talking to some other people, but that's a time for you to really signal, these are the things I'm worried about and this is what I'm doing. Or that's also the time you talk about, you might or might not be running out of money and what are you doing? You might or might not be in discussions for M&A, those kind of things that you really don't want your team to be worried about. So that happens, with the CEO and the board, is that that can be a very open and honest time, I think. And then there should be a part of the board meeting where the CEO leaves and it's just for the directors. And it's for the directors to say, what do we think about this meeting? What do we think about the CEO? What do we think about what's going on in the company? What is our feedback as a board, so that ideally one person from the board can go back to the CEO and say, hey, here's what we're really jazzed about, here are our concerns, here's some ideas we have for help. But it should be a regular process, a regular occurrence that there is a part of the board meeting that the CEO is not attending at every single board meeting. So that there doesn't come that day when you ask Steve Jobs to go take a walk in the parking lot before you walk in. But it's a good way, but those board-only sessions are a really good way. They're also a place where the board members can reinforce good social behavior among the board members. That's a place where the board member can say, hey, we've got this new person and you were sitting there all grim-faced, scaring the daylights out of that poor new VP of marketing. Let's make sure that we remind him, we're really excited that he's here, something like that. So it's that private place where the directors can talk about their behavior, the CEO's behavior, and then also build consensus and take the information back to the company without every board member then needing a post-board meeting follow-up one-on-one with the CEO too.
Dan, you're nodding. How do you want to hear feedback from your board?
Face first. I mean, I think communication is a two-way street. I'm going to tell my board and my board members what I think and how I think they're doing as board members, and I expect them to do exactly the same thing to me. And I think it's pathological and can be disastrous if that isn't the way things are handled. The last thing, the way you get surprised is when you teach people that they shouldn't give you feedback, whether they're your board or your colleagues or your employees.
Jules, Sharon mentioned the investor-only session at the end of the board meeting. How often should board members be interacting amongst themselves offline from the formal meeting to discuss what's going on? And obviously it's going to differ depending upon the situation and the stage of the company, but how do you usually interact with other board members about a company?
Yeah, I mean, the venture business is so social and you're always out doing things like this that you end up seeing enough people that, I don't have formal meetings with any of the sort of the other people on the boards that I'm on. But you end up seeing them enough that, you know, when you do see them, you talk about the company. I'm not a huge fan. I've actually, a couple of my companies do the executive session without the CEO, and a couple of them don't. And I could really go either way on that one. I really think it's important to have the CEO without the team, because I think you learn more about the business, and often over a dinner or over something social, you end up really understanding the business through that interaction. I'm not a big fan of this feeling that, because the CEO knows what happens in those small meetings, right? We gossip about people on his or her team. That's what we do. We say, the marketing person looks weak, or the CFO is bad. So if we're having meetings where the CEO is not attending, they're basically thinking that that's what's happening, and in often case it is. So, I prefer, if you're really having a problem with the CEO, I think the best thing to do is actually have a discussion outside the board meeting where you can get the other board members, on the phone or one-on-one. And if you really need to make a change, I think that's better than, really using that 15 minutes when the board meeting's sort of wrapping up to have a big discussion about whether to fire the CEO. So I think the CEO should always feel supported by the board. They should feel like they're getting transparent feedback, positive and negative. But at the end of the day, the CEO should leave every board meeting feeling like the board has 100% confidence in that person. And I worry about that sometimes in those private sessions.
So one of the questions from the audience was the single biggest frustration dealing with the CEO, and I want to make that bilateral. I'll ask the VCs what the single biggest frustration is dealing with CEOs, and I'll ask the CEOs what's the single biggest frustration dealing with VCs. I'll let you guys pick who wants to go first. Otherwise, I'll pick Gary.
Well, I think I already said it. For me, it was the very tactical, very, hey, have you thought of this, or this feature or that feature? It's just very tactical, not strategic or not forward-thinking advice. That's really time-consuming. One other thing is we had one of our investors that would ask us to fill out their very detailed spreadsheet every quarter, and so request would go to the CFO and say, please fill out our metrics in our format, and that was just a exercise, and it's probably burned 3 hours of our finance team's time filling out their numbers, and that was just a pain in the neck, and I went back to that firm and said, yeah, we're not going to do that anymore. So those kinds of things that consume energy and do not add value for the business.
Yeah, in the room, the most annoying thing is the board member who needs to be the smartest person in the room, by far. And the other really annoying thing that, for me, is people who don't know what they don't know. Like, I have no problem with you not knowing certain things. I have a big problem with you not knowing you don't know it and trying to help me with things that I know a lot more about than you do. And you'd be shocked. I mean, those two things are related, but those are the top of my list.
Yeah, I think the lack of, if and when there's a lack of transparency, that's the hardest thing to deal with, because you can't, you heard it from all of us. We want to have an open, direct, honest conversation with the CEO. We do, as an investor, I expect that there's going to be all kinds of problems, right? Even in the biggest success scenario, there's just all kinds of issues that come up, and that's fine. But please be honest about them. One of the worst CEOs I ever had was somebody who, told his team, like, we're not going to let the investors crawl up our, and he closed the company to everybody, which also, when you stiff arm your board, it means that we're not on the same team. So, I'm sitting there going like, sure, you want to run it that way? Fine, but when you trip, I'm not bought into your success. And in fact, actually, after we fired him, he came to my office and told me like what an evil person I was. And I'm like, okay, do you ever want to work in this town again? Like, do you want me to help you find another job, or you want to just tell me I suck? Okay, that's fine. That's your choice. But so having the transparency breeds being there to get. I love companies where all the KPIs are on a big screen or a big whiteboard or someplace where everybody knows how we're doing together, because just remember, your investors make the most money when you make the most money. There are very few scenarios in Silicon Valley where investors make money and the entrepreneurs don't make money. So we want you to win. So please just make it a two-way street.
Jules?
Yeah, I mean, I think the transparency is really important. By the way, the other behavior of board members is probably my most frustrating thing in a board meeting too. and so it's not something that, it's something that everybody sees and needs to be aware of, and I think that's where you can use your board to help influence other board members. But I think, I mean, I know this panel is about board meetings, but at the end of the day, I just care about, are you building a great business? And if you spend too much time over-optimizing the board meetings, or, you know, like the thing I hate is the CEO said, oh, we were up all night the last week putting together the board packet.
Yeah.
How's the business doing? So, so I really think just build a great business, build a great company, hit your numbers, hire great people, perform, we'll be nice to you, we'll ask good questions that hopefully are additive. You know, my favorite quote, I do think venture folks can add value, but one entrepreneur told me that, you know, 120% of a venture capitalist's value is in their investment. So don't.
And it goes down from there.
Yeah. No, I mean, don't disrupt a company. So.
You know, I think we're all saying the same thing, and I had a boss once that said, everything's funny when you're making money. So when things are going well, this is all great, but guess what? Things don't always go well. We had a really rough patch around some regulatory complexity. When you're sending money, oDesk was sending $40 million of money around the world a month, and when you're sending that kind of money around the world, guess what? Somebody may come calling and saying, are you allowed to send that money to this country? And it is very, very, it was scary, right? Like, you have to make sure that you're doing that in a safe, legal, compliant, fast way, right? And we really got to see who got in the boat with us and who didn't. Like, everybody had to add value. We had to say, okay, who do we know? How are we going to handle this problem? What additional law help are we going to need? And it was really an opportunity to see our board come together and problem solve. And I was super impressed with people I didn't expect to get in the boat. And at that point, we added another independent board member who was very, very knowledgeable about the topic. And somebody brought him to the party, and he said, look, I'll just do the work. And if you like the work, we'll figure out what I get paid and whether or not I become a board member. But let me just get in the boat with you guys, because I think I can help. And it was unbelievable to see that guy step up and lean in and really, you know, grab oars and start rowing. So I think, you know, everything's funny when you're making money. You have to try and get into you have to get into the muck to see what really people are made of.
Right. I mean, so there's been a lot of advice about doing due diligence on your potential investors or potential board members before you let them join your team. And to me, I think one of the most important questions to ask, for example, other CEOs who that investor has backed, is when you had bad news, how did he or she react? I mean, that's the most telling thing, is when when you called up on a Friday afternoon with the bad breaking news, how did the person take it? What did they do? Was it constructive?
I always tell clients that the one thing they have to do to reference check is talk to CEOs of companies that failed, because that's when you truly know whether somebody's a good board member or not. So, getting away from the negative for a second, what's your favorite attribute? I mean, what's the one thing that you wish that all VCs did during a board meeting or between board meetings? What's the positive thing that you wish they would all do and that some have done? I'll start with whoever. Aaron.
I mean, to me, and I have one of these on my board, it happens to be Sharon's partner, the best board member feels like another member of the executive staff. Like, they have command of the business, they're thoughtful and strategic, and they ask good questions, and they add value to every conversation by asking questions or coming at things from a perspective that nobody in the company has thought of. They know when to do that and when not to do that. And they're helpful, both in the board meeting and outside the board meeting. I mean, a great board member, whether independent or investor board member, is constantly asking what they can do to help, accepts nothing right now as an answer with happiness, and when you have something you need them to do, they're willing to do it. And when they perceive a problem, they don't like the way something is presented, or they're concerned that some question isn't being framed properly, their answer isn't go fix this. Their answer is, let me sit down with you and help you understand what I have in mind. I will do the work if I need to do the work to make this get better so that we can all get on with life. And they're good facilitative leaders. They help keep the process moving, both inside and outside the board meeting. I mean, that's a lot of stuff, but.
Gary?
I kind of appreciate people that have skills that I don't have, and so I would say the board member for us that was most strategic, just ruthlessly prioritized, has this ability to focus on the difference that makes a difference and not sweat the small stuff. I'm more of an operator, sweat the small stuff, so I think I get the most value out of somebody who's most different from me. And it's that ruthless prioritization. He was the guy at one point that told us that we were over-measured and under-prioritized. We had too many metrics, right? And so just that nice piece of guidance forced us to, take 8 metrics and boil it down to 3, the 3 that really mattered. And it's not that the other 5 weren't important, it's just that these 3 were the most important. So it's that ruthless prioritization and no time for the mechanics or he understood the business because he was so smart, right? Not because he ran twice as fast.
Jules, what's the favorite attribute of a good CEO dealing with the board?
Yeah, I mean, to take the analogy of a marriage, I mean, you're in a sense getting into a marriage with a board member, and I think you have this intense dating period, which is the financing, right? Where you learn a lot about somebody. You have multiple interactions over a number of weeks, and then all of a sudden you become a board member, and it's weird for me, and probably weird for the CEO too, that all of a sudden your cadence of interacting is now every month or 2 in board meetings, and a really good CEO, I think, invests in the board relationship post the financing. So you have a frank discussion. I had this discussion with one of my CEOs who said, here's how I want to interact. I'm going to tell you when anything goes bad. If I want your help, I'll tell you. If I'm not talking to you, assume everything's great, because and don't bother me with, can I do this, can I do that, and it was great feedback for me, because I was like, okay, I know how to interact with this person, but the relationship doesn't end with the investment. It's kind of, that's when the marriage is just starting. So I love, I'm in this business not because, I would never want to work for a hedge fund, just picking stocks, and I'm in this business because I love interacting with management teams, with CEOs, and so I really want that interaction, and I want to make it as productive and helpful for that person.
So what did you tell the CEO that you wanted from the relationship?
Transparency. So he had already said it. He already said, I'm going to tell you when something's, that's all I want to know. And I do, it's fun. I think Dan made the comment, like, board members get most excited when they feel like they're adding value. So that's why that one slide makes me really happy, because that's my, now I've got something to do. And it was really helpful for the CEO to tell me that you are doing a great job. If I don't ask you for anything, you were doing a great job. You are doing exactly what I want. If you're pushing candidates on me, you're asking about Japan strategy or mobile, and I haven't asked you for any of that, you're not doing a good job. So I knew exactly what that person wanted, and it was helpful for me, and he had already said the things that I wanted from him.
Sharon?
Yeah, I think I really like, well, the thing I'm really looking for in CEOs, in addition to hit the numbers, is the team building aspect. Because that's what gives me confidence that CEO is going to be able to be the CEO over the long haul, as if he or she is always bringing in new great talent to the organization, whether it's at the board level, at the executive level. And so just that sort of, keeping me apprised of what's around the corner, what kind of talent are we looking for, so that so that I'm keeping that in mind, and I know that that person is thinking for it. I mean, I think the companies that in my own portfolio where I've seen them under execute to an opportunity, it's generally been because they haven't been staffed with high enough quality people early enough. They've taken too long, the CEO has taken too long to hire the right people into the right positions, and you lose a couple of quarters. And if you have a couple of quarters of 60% year-on-year growth when the market could have given you 120% year-on-year growth, you just lost another turn or two on your money. You lost $100 million of valuation. So, I mean, I did a presentation for this executive in this portfolio company and said, if you had made these investments, this is where we could be, this is what that would be worth to you personally, so please get on the bandwagon and hire faster. And in fact, this year we're ahead of plan, finally.
So, any questions from the audience? This time we'll actually do the answers.
Yeah, with regard to kind of replacing the CEO, when the board kind of makes that call or is kind of prepping for that call, is the only option outside the company, or could they kind of go into a CTO role because they might have had a really big hand in architecting and building out the underlying architecture, things like that?
I think it depends. Dead battery. It depends on the motivation of the person, but also of the company, right? I mean, if it's somebody that can add value and is happy contributing in another role, then I see no reason why they couldn't. But again, it depends on the personality and the motivation and the needs of the company.
Yeah, there are lots of examples where that works, but it's also probably the most pathological thing that can happen to a leadership team. If you get a founder who was the CEO, who's still around in a different role, and who isn't prepared to get on board with that and play nicely with the new leader, very, very bad things can happen. But there are lots of examples of it working really well. Dave Hitz, one of my classmates at Network Appliance, is a perfect example of that. He's been CEO, he's been VP of engineering, he's been not with the company. I mean, he keeps going back and forth, and he seems to be completely able to play nicely as a member of the team in whatever role he finds himself.
I'll add my note, because we see it a lot of times, and I would say more often than not it fails, because that founder transition to CTO, that's kind of a meta-stable state, and so it's the rare person who was able to build a successful engineering team and build a successful company, bring in a new CEO with a different skill set and play second fiddle. It's just it's an unusual cluster of personality traits that can do all of that. It's a special person.
So just the way that transitions are often structured is because as a board, you want it to work, right? I want the portfolio companies to have that founder spark present in the company over the entire life of the company. I really do. However, it may be my responsibility to place new leadership in charge. And so often you have a situation where you're wanting it to work, you structure the deal both for the person who's stepping down and the new person who's stepping up, whether it's from outside or from inside, such that it's the new CEO's decision whether or not to let go the old founder, because you have to put the CEO in charge. CEO is in charge of his or her team. You can't say there is this protected class over here who you can't touch. You can say, think very carefully about touching, because if you extinguish the entrepreneurial spark and let go of the last founder in this company, that is a state change where you have only hired in management and no founder. It is a psychic state change for a company. So you have to think very carefully about going there. Yet you have to empower the CEO to be able to make that decision in consultation with the board. So often the person who's stepping out of the CEO role has a sort of sometimes a two-step severance package, for example. It's like, when this is your new deal as CTO or strategic advisor or chief strategy officer or whatever the role is, and here is the already pre-negotiated, self-executing deal if you are asked to leave the company, and that's what happens to your board seat, what happens to your stock, do you have a longer time to exercise, all those kind of things. And that's also how, as a board, by the way, you get a very strong signal from the founder CEO, when you start having these discussions, and the first it's like clinging on, no, you make a mistake, and then when that person transitions to, what's my deal? Then you know that that person has mentally come, maybe at least to an intellectual understanding that there is going to be a new CEO. There may still, and then the big question mark is, emotionally, can that person humble him or herself to actually be the subordinate to the new CEO? But there's a big signal. It always happens. You go like, when that person hires a lawyer and says, okay, what's my deal? What's my package? Like, how big is the severance check? You know, how much vesting do I get? That, you know, like, oh, phew, at least we're past that intellectual roadblock.
We, just as I think about it, we actually did that. So I came into oDesk and the founder became the CTO, and he's still with the company. So it was, for 7 years, he added a tremendous amount of value and knew that he wasn't the CEO. So I think it's not necessarily up to the board, it's up to the CEO, right?
So maybe this is a question without an answer, but hire great people fast and use your cash and stock sparingly in doing so is a typical board directive. Tell me about some clever solutions to a very constrained challenge.
I'd use your stock, hire great people. So I don't think, when I see a company say, hey, we're about to hire this great CFO and it's going to cost us 1% of the company, if it's a great person, I love it. I actually love when we over-equitize amazing talent. So I don't think my job in the option pool is to limit it. I think my job is to use it as efficiently as possible to hire the best team of people. So that's, always watching that cash balance, I think is that's the key thing for a company.
The problem is that flip a coin as to whether or not you get hiring, right? I mean, it's just incredibly hard. And I think people go to work for 4 reasons. They go to work for impact. They want to go somewhere where they know they can make a big impact on the business, and even better if that business is making an impact on the world. Second, they go to work for growth and development. They want to learn. A year from now, they want to be more valuable than they are today. The third is good financial reward, of which equity is a piece of, but there's also cash compensation, maybe there's a bonus, there's other things. And then the fourth thing is what I call balance, and balance varies from person to person, as does the order and the prioritization of those criteria. And if you're not selling the total picture, then you're doing yourself a disservice. And if the candidate has prioritized financial reward as number one, they may not be your best candidate. And so I think you have to get back to that motivation. What is it that they want? Before you can sell, you have to know what it is they're buying, and then you have to sell that in order to get great candidates.
Next question.
What's the standard frequency for these types of board meetings? And then the secondary question is, are there any board meetings where they'd be skip level, where the CEO wouldn't be there and it would be with the executive team?
At oDesk, we were board meeting every other month, so 6 board meetings a year, and the CEO was always present.
Normally, the CEO is a board member, so it would be unusual for the CEO not to be there.
I think it's almost always the true in young venture-backed companies in the Valley that board meetings are monthly initially, and then eventually they become less frequent, every 6 weeks, every 2 months, every quarter. Sometimes if it's quarterly board meetings, usually there's a call in the middle of the quarter or something like that.
Right, I mean, you can think of them, to me, the minimally viable number of board meetings is 5 or 6, because you need 1 for each quarter, plus generally at least one that's an annual planning board meeting, but often that's 2, where there's one where you have a first draft of the plan and one with the final approval of the plan, or one that's plan related and one that's financially plan related for the coming year and one that's strategic plan related for the coming year. But Dan is right. So, but young companies, especially when you're in early product development, early in that, trying to achieve product market fit, those are monthly board meetings.
The one caveat, we see a trend for very early, Series A companies where you have a VC, the CEO, maybe you have two founders where it's a 2-to-1 structure. A lot of times where the CEO is talking to the VC regularly, in many cases they're talking at least once a week, there's no need to have a board meeting. If there's something that the lawyer says, hey, you've got to approve this, either you have a quick board call, or more likely you just do it by written consent, and you save the time and the energy of having a formal to-do.
Right. Yeah, yes, it's really, like I had one early stage company where we had board meetings were larger than the number of employees. That was just a mistake.
If you have to hold your board meeting at your law firm's office because you don't have a big enough space, that is something that you should consider whether that's the right call.
At any stage of the company.
Yeah, exactly. And we have some big rooms that could fill.
What are some good hacks that you guys might know of, like boardroom hacks? Like for example, my team and I, we would literally hand out a red card to everyone when we started to do our board meeting, and if one person was rambling, like someone at any time could kind of hold it up, and it's like you're on notice. And the second person would hold one up, and it's like,
I love it.
stop immediately. And so, like, that's a hack that we employed that everyone loved, and that they were actually taking to other boards. And so, like, what are some examples like that of just weird stuff that you've seen that works really well, that maybe would be cool in another board environment?
If they get a red card, are they also out for the next board meeting?
Well, it's just for that moment. It's just like if you're done talking, right.
I mean, I had a CEO who did something similar, where not the red cards, but he wrote kind of to what kind of Gary talked about, like a letter with all the priorities of the company and some metrics in it. And he said in advance, you will read this letter, I gave it to you 4 days in advance. If you ask a question that is contained in the letter, I'm gonna call you out in front of everybody. And somebody did it. Somebody asked, someone said, well, why are margins going down? That was in the letter. So you got called out. So I think it's essentially like that red card concept, but I think having that, we're all human too, and we don't like getting called out in front of, our peers. So it worked.
Well, everybody feels it, and so it's like one of those things where there's clear rules of how you're playing, and so the person's not embarrassed. They're like, oh, yeah, you're right, I was rambling, cool, let's move on, and so.
This might be construed as being self-serving, but if you distribute your board information to your board members using some tool that lets you know whether they've looked at it or not before the board meeting, because they know you know whether they've looked at it.
How common is the use of those board portals in companies, Series A, Series B now? Are you using them? Board portals, like you were just describing?
I will tell you from my experience in early stage companies, occasionally, but that's typically when the materials are particularly voluminous for that meeting. Either you're including 409A reports or something special that makes email unwieldy. In my experience, most people, no offense, but for this particular purpose, the email tends to work better because VCs look at it on their iPhone, or they look at it when it comes up. All right, thank you very much.